Have you ever wondered why financial experts often give seemingly contradictory advice about loans? Always get a mortgage when buying a house, they say, but in the next breath warn, never finance a car. This contradiction feels puzzling until you understand the psychology and economics behind these recommendations. Today, I'll unpack why mortgages are typically considered smart financial moves while car loans might be draining your wealth without you realizing it. The key difference lies in one crucial factor: what happens to the asset's value over time? Homes typically appreciate, they gain value, while vehicles almost always depreciate, they lose value, often dramatically. This fundamental difference changes everything about how these loans impact your financial health. When you buy a property with a mortgage, you're leveraging your money to acquire an appreciating asset. Historically, real estate has increased in value at an average rate of 3 to 5% annually in most markets. This means your home might actually be earning money while you live in it. If you put down $50,000 on a $500,000 home that appreciates by 4% yearly, you've gained $20,000 in equity in just the first year, a 40% return on your initial investment. Mortgages also offer substantial tax advantages in many countries. Interest payments are often tax-deductible, effectively reducing the true cost of borrowing. Additionally, mortgage interest rates tend to be among the lowest available to consumers, typically 3 to 6%, depending on market conditions and your credit score. When you factor in inflation, which averages 2 to 3% annually, the real cost of borrowing can be surprisingly low or even negative in some scenarios. Paying cash for a home means tying up a massive amount of capital in a single asset. That money could potentially earn greater returns if diversified across different investments. A mortgage allows you to maintain liquidity and investment flexibility while still building equity in your home. Now, let's look at car loans, where the financial dynamics work against you. The moment you drive a new car off the lot, it typically loses 10 to 20% of its value. By the end of the first year, most vehicles have depreciated by 20 to 30%. This rapid depreciation creates a dangerous financial situation when combined with financing. Car loans typically come with higher interest rates than mortgages, often 6 to 10% or more. This means you're paying premium interest rates for an asset that's actively losing value. It's a double negative effect on your finances. If you finance $35,000 for a new car that depreciates 25% in the first year, you've lost $8,750 in value while still owing most of the original loan amount plus interest. You're literally paying extra to lose money. The psychology behind car purchases often leads to spending more than we should. Monthly payments make expensive vehicles seem affordable, but they obscure the total cost. A $500 monthly payment might not sound excessive, but that's $30,000 over 5 years plus interest for an asset that might be worth less than half its original value when the loan is finally paid off. Another compelling reason to avoid car loans is the hidden pressure they put on your financial flexibility. The average car payment in America now exceeds $600 monthly. That's money that can't go toward building wealth, handling emergencies, or pursuing opportunities. This ongoing financial obligation can trap you in jobs you dislike or prevent you from taking career risks that might ultimately lead to greater income. So what's the wiser approach to vehicle purchasing? Financial experts typically recommend buying a 2 to 3-year-old car with cash. At this age, the vehicle has already experienced its steepest depreciation curve, but still has many useful years left. By paying cash, you avoid interest costs entirely and own the asset outright, eliminating monthly payments from your budget. For those who can't afford to pay cash for a car, the next best strategy is to make the largest down payment possible and choose the shortest loan term you can manage. This minimizes both the interest paid and the risk of being underwater on the loan, owing more than the car is worth. Remember that transportation costs extend beyond the purchase price. Insurance, maintenance, fuel, and parking all add up. The total cost of car ownership often reaches 20 to 30% of many household budgets, a significant drain on wealth building potential. The exception to the "don't finance cars" rule might be when manufacturers offer zero or very low interest promotions. In these cases, financing might make mathematical sense if you invest the cash you would have used to purchase the vehicle in something that earns a higher return than the interest rate on the loan. Next time you're making a major purchase decision, remember this crucial distinction. Borrowing can be a powerful tool for acquiring appreciating assets, but it's typically a wealth destroyer when used for depreciating assets. Your future financial self will thank you for understanding this seemingly contradictory but economically sound advice.